Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're talking software and why it might be attractive to investors with Tyler Ellegard, Portfolio Manager at Gradient Investments. More than 8 million computers globally were crashed on July the 19th after a failed security update to Microsoft Windows by CrowdStrike. That episode drawing negative headlines to a sector that our guest today argues should deserve more positive thoughts. Software stocks have been an underperformer relative to the S&P 500 and especially against their mega-cap tech peers like Nvidia, with investors caught up in the stampede of interest in AI. But software stocks too should be a beneficiary of the AI play, the argument goes, boosting efficiency and margins. Well, the man behind the argument is Tyler Ellegard of Gradient Investments. Welcome, Tyler. Many thanks for joining us today. You're going to tell us about some stocks that you like in a moment. But first of all, just outline, if you will, a little bit more about the rationale behind looking at software stocks.
Sure. And as you mentioned in your opening statement there, these software stocks have underperformed not only the S&P, but their mega cap tech peers. And you can go down the list of the Mag 7 or Fabulous 4, however you want to slice and dice those names. But they've really underperformed this year. And I think part of it, rightfully so. I mean, the Microsofts, the Nvidias, those are very well-known AI stories, right? But when it comes to software should get a very large tailwind from AI as well. Not only efficiencies, but also the chance to upsell their products to their clients.
Now, a number of commentators in recent days have told us that they're concerned a little bit about the impact of AI on the tech industry in general, that tech companies are failing to define clear use cases for AI whilst also spending rather too much on it. To what extent do you think that's a problem for software?
So I think there's a lot of concern about the spend, and I think that's a very valid argument. However, these companies really need to spend this CapEx today so that they can have the build out and the capacity to do this in the future, because we've heard from a number of different companies. I think Meta was one of the most notable on their earnings call just last week. They went from 350,000 100H GPUs from NVIDIA to 600,000, right? So they need the capacity to do this, to create these large language models and train them. So the next couple of years, there's going to be a lot of CapEx that goes towards this, just so they can have this build out to be able to have the capacity going forward.
Now you have three stocks that you like, that you want to talk about. The first of those is Palo Alto Networks, which, should you say, profit from the recent debacle at CrowdStrike?
I certainly think they will. We saw a number of wide-ranging estimates of how much the CrowdStrike debacle costed the S&P 500 companies. But I think when it comes time for those companies to update their contracts, I think they're going to start to look elsewhere. And Palo Alto is right in that network. One of their big products is firewall, but they're also in that endpoint security, just like CrowdStrike. They're not the pure play, but I think from a longer term, this security secular growth story is going to continue, and Palo Alto sits right in the perfect spot for that right now.
So that's the security space. There's also the cloud computing space, where you rather like ServiceNow.
Investors have been concerned about what their billing cycle has been like. But we saw in Q1, their billings were up 13% quarter over quarter, and now we're up 26%. So the trend is back where investors like it, to be able to pay for that type of valuation that we're used to on ServiceNow. So I think this trend continues. It's again, this clouds or this AI space will only be better for this company going forward in terms of efficiencies.
Talking about AI, you like Intuit. You think Intuit is a company that's going to ride the wave of AI. Tell us about that.
Yeah, when it comes to tax season, if you can have a AI chatbot help you through the different line items, because we all know that tax season is not the most enjoyable. So, it's going to create efficiencies for Intuit in the long run. And so I think from a margin perspective, it'll be good, but also from the ability to, again, going back to that upsell to their clients. If you want this AI chatbot, maybe for the next year or two, they might allow it to be free, but as long as you continue to use it, you get used to it. At some point, they're going to start to price that into their packages. And I think that's going to be a very big tailwind for them going forward.
As we record this, there are huge gyrations in the market. There's a massive tech sell-off. Where is software going to end up?
I think from the margins perspective, from the growth perspective, I think it's a secular growth story for this space. And so I think we're just taking a breather right now. And I think this would be a good time actually to get into software because I think from a longer term perspective, it's a great spot to be.
Tyler Ellegard, Portfolio Manager at Gradient Investments, many thanks for sharing your thoughts with us today. And that is your roundup of the US software sector. I'm David Pollard. This is Reuters.